Hello and welcome to another episode of Wescott's webinars. I'm Mark McCarron, Wescott's Chief Investment Officer. And this week we're going to focus on the economic recovery that is beginning, we think, but really what shape will it take? And that's a big question we're reading quite a lot about, and quite a few clients' questions are coming along those lines. So what we wanted to do, as usual, focus in on really a quick update on the market through May 8th. And a review of the Wescott portfolio framework. Effectively, how are we positioned? Why are we positioned that way? And what's going on in that environment? And then finally, we're going to take a look at the economic outlook scenario. And we're going to refer to a couple of scenarios using some popular letters, a U-shaped recovery, a V-shaped recovery, a W-shaped recovery, or an L-shaped recovery. And we'll explain a lot more of that as we go through the presentation. So quick update on the markets through May 8th. First, the estimates of economic growth, GDP, inflation, consumer spending, consumer confidence, all of which have come out the last couple of weeks, show significant impact from the global lockdowns. We're going to talk a little bit more about that shortly. The next key theme, I think, in the markets is that the volatility in the stock market and the corporate bond market has moderated to some degree, and that's in the face of pretty negative return or negative growth expectations on the economic front. And I think it really has a lot to do with the shift in mentality from a lockdown mentality, which is like we're here to stay, versus a potential reopening of the economy as the virus takes its natural course. So let's take a little look at the economic growth expectations for the second quarter of this year. First and foremost, we're expecting a recession, in fact, the deepest recession since the 1930s in technical terms. I'm going to just point to this graph here. This is a graph that shows the GDP growth rate over the last 10 years since 2010. The blue line shows that the growth rate trend has been at or around 2.5%, really since 2008, 2009, which is pretty stable and strong growth in the US. However, the impact of the pandemic can be seen more recently here with a drop of minus 4.8% growth. That's for the first quarter. And what we've also done is included a line, the orange line here, which is called the GDP nowcast. It effectively updates the GDP official number with some more recent factors, in fact, about consumer spending and business spending. And by including that more current information, what we're seeing is that the GDP expectations are going to drop much, much further. In fact, all the way down to minus 17.6% based on this estimate. Now, that is pretty remarkable. Never has been that quick of a decline in GDP, even in the 2008-2009 timeframe where we had the last recession. Global GDP was around zero, and we clearly had a couple of GDP growth rates that were in negative territory in the US, but nothing as severe as this. We also learned this morning that the unemployment rate in the US is approaching 15%, which again is unprecedented. But I think it's important to note that there are differences today versus past recessions. And the first, the most important one, is that this recession, as deep as it is self-induced. It was designed as a result of the lockdowns that were mandated, not only in the US, but globally. And for good reason. But that is a self-induced slowdown, self-induced decline in economic activity. And to compensate for that, there's been significant fiscal stimulus, support, the CARES Act we talked a lot about, support for small businesses during this self-induced lockdown. That has gone a long way to help certain businesses. I know there's a lot of questions about how it could be more helpful, and hopefully that does occur over the coming months. There's also been significant monetary stimulus. That's what we talked about before with the Federal Reserve providing a lower interest rate and supporting financial institutions. So unlike other recessions, the three differences are this is self-induced. Secondly, it's been very significant, massive stimulus, both in a fiscal sense and also a monetary sense. And that's important because that's what the market is looking at. If you look at what the market has done since the first quarter, there's been a pretty broad rebound. So far in the second quarter, or at least since the low, the S&P 500 is up 25% from where it was March 23rd. We're encouraged to see that the gains made in April and so far in May have been broad-based. And even some of the economically sensitive sectors have participated. Again, really as a result of the support that we're seeing from from both the U.S. government and also the U.S. Federal Reserve. One thing we wanted to talk a little bit about is just the way the portfolios at Wescott are constructed and the way in which the rebound, if you will, so far this quarter has occurred. And as we talked about last week, there's continues to be a fairly narrow market, meaning that the U.S. market, shown here, so far in the second quarter is up over 12%, while the U.S. or the non-U.S. market is up closer to 6%. So a doubling already of the U.S. market that already did better up until this point this year. So there's a preference clearly by investors for the U.S. market. I think it has a lot to do with the fiscal and monetary support that we talked about. The second trend that continues is that the most economically sensitive sectors of the market, while up 6% and 8% in terms of value investing, and value investing is investing in those economically sensitive sectors, energy, materials, industrials, they're up, but not as much as growth sectors. And we're seeing that very clearly, whether they're small companies or large companies, those companies focused on technology, healthcare, and other growth industries continue to do well, not only in the down market, but also in the up market. And what we found is that the NASDAQ, which is a representation of large cap, US-based technology and other growth companies, is actually in positive territory this year. And it's something that we added to the portfolios, as you remember, in March, in the depths of the sell-off. A reminder that the portfolios we're building are built for today, to withstand the volatility and also have the resilience to get through the next several months. But we're also building portfolios in preparation for tomorrow. And tomorrow really is as and when the market recovers, as and when the economy recovers. We want to have positions in the portfolio that will lead us out of that. And traditionally, it's been the value sectors of the market, those that are most associated with the economic cycle. When that cycle turns, they're the ones that typically do the best. And we remain allocated to and exposed to those areas of the market. So that really brings us to the economic recovery and what shape will it take. So we've got four potential scenarios here. We start first with the U-shaped recovery, which is our base case. And what that means is that we will recover, we think, our GDP growth rate back to trend to 2.5%, but it's going to happen slowly and perhaps unevenly. The slow reopening of the economy will occur in certain sectors, certain areas of the market and of the country, but not maybe in others. And even if we do reopen the economy, we expect that there'll be aspects of social distancing still required, whether it be wearing masks, intervals of workforce in and out throughout the week. But all that said, that will allow the economy to recover. And that will give consumers a little bit more confidence to spend and businesses more confidence to invest. We get a lot of questions about this next one, V-shaped recovery. So the market seems to be recovering very quickly, but is it anticipating a V-shaped recovery? We don't have this as our base case, but a V-shaped recovery means that we're going to recover economic growth much faster. And that will be really determined by whether there's a vaccine or a treatment that's identified earlier than expected. There's a lot of global research being put toward that effort. And there's some, as we mentioned last week, some relatively good news as to progress being made in that space. If that were to happen, consumers would go right back into, we think, not normal, but absolutely getting more confident to put money to work and to spend again. That would be a great scenario, and a scenario that is better than a U-shaped recovery. But we've also had questions from clients about what a W-shaped recovery looks like. So as you can imagine, that will involve another decline in economic growth. And that may occur if there's a second wave of infections, particularly in the later half of this year. That might require another lockdown. And unfortunately, that would cause unemployment rates, as they've spiked today, to remain relatively high. And I think it would do some damage, again, to the consumer and their confidence in their spending habits. We don't have this as our base case, but we clearly identify it as a risk associated with any economic recovery. And then finally, an L-shaped recovery, which would be the worst of the four. In this case, it would be permanent damage, meaning that the decline in GDP would be fairly permanent. We wouldn't get back to our growth rate of 2 to 2.5%. It would result in some bankruptcies and very significant change behavior on the consumer side. Meaning, you may not do what you normally would do in this case going forward. So the L-shaped recovery is the worst case scenario, we think, but it's a low probability because there's evidence and progress being made on first vaccine or treatment development, and also living with and working within environment and an economy with some aspects of social distancing. As a reminder, our portfolios are built with enough diversification and resiliency to withstand the current environment, and also to withstand a recovery no matter what shape it is. We do have a U-shaped expectation as our base case, but we want to highlight the fact that we've improved the quality of the portfolio. We've managed the balance between small and large. We've managed the balance between more high quality bonds in the portfolio, all to say that if we were to experience a W-shaped or even an L-shaped portfolio economic recovery where the portfolio is balanced and has the resiliency to manage through it. So with that, that's our view and our outlook. We've introduced some new concepts, economic growth definitions. Those are here for those who are interested in reading more. As usual, we thank you for joining us during these weekly updates and for your continued trust in Wescott. Please don't hesitate to reach out to me or your advisor with any questions you might have. Thank you.